Hey everybody, welcome back. Today we're doing a deep dive on something that you hear all the time in the investing world,
Hmm.
average returns.
Yeah,
Um, we're gonna take a look beyond just those simple numbers
right.
and really see what they mean for your money.
Absolutely.
Because it can be a little misleading.
Well, it's almost like a magic trick sometimes. These average figures,
Right.
they can make investments seem a lot more appealing than they really are in reality.
Yeah, and so today we've got a book and some online resources that are really going to highlight this problem
Okay.
with using average returns as a way to gauge your investments.
Gotcha.
And it all boils down to the impact of negative years,
Yeah.
the years when the market takes a dip.
And that's a crucial point that often gets overlooked.
Yeah,
It's not just about how much you gain on average.
right,
It's also about how those losses, when they inevitably occur, affect your overall growth.
right. And the book uses a really simple example to illustrate this.
Yeah.
Imagine you invest $1,000
Okay.
and it loses 50% in the first year.
All right.
So that leaves you with $500, right?
Right. And even if the market rebounds the next year
Yeah.
and your investment gains 50%, you're still not back where you started.
Right, because that 50% gain is only calculated on the remaining $500.
Exactly.
So you only gain $250 back,
Right.
which leaves you at $750.
Yeah.
Which is a 25% loss from your initial investment.
Precisely a $250 hole you have to climb out of.
Right.
Even though the average return over those 2 years would look like it's zero.
Yeah, it's kind of mind-boggling when you think about it.
It is.
The average return suggests you break even, but the reality is quite different.
Absolutely.
And this isn't just some theoretical concept. This plays out in real-world investing all the time.
All the time. That's the danger of relying solely on average returns.
Right?
They can create this false sense of security and lead investors to make decisions that
Yeah.
don't align with their actual risk tolerance.
Right. The book even points out how the S&P 500, despite an average return of over 10%
Right.
for a specific 20-year period,
Yeah.
might not reflect the actual experience of many investors.
Yeah, and this is where it gets really interesting.
Okay.
You see, the problem lies in the way we calculate averages.
Oh, right.
When you have positive and negative numbers,
Uh-huh.
the average doesn't always accurately represent the true outcome.
Can you elaborate on that a little?
Sure.
I mean, I get that losing money throws things off, but
Yeah.
how exactly does it work mathematically?
Think of it this way. Imagine you have 2 buckets of water,
Okay.
one hot and one cold.
Right.
If you pour them together, the resulting temperature won't be the average of the 2 original temperatures.
Ah, I see. So it's like the cold water has a greater impact on bringing down the overall temperature.
Exactly.
Okay.
In the same way, losses have a disproportionate impact on your investment returns.
Right.
A 50% loss requires a 100% gain just to get back to even.
So even though the S&P might have averaged over 10% over that 20-year period, the actual returns experienced by individual investors could have been significantly lower.
Absolutely. And this is where a website like MoneyChimp can be incredibly useful.
Okay.
It allows you to see the difference between average and actual returns for different time periods.
So we've established that average returns can be misleading.
Right.
So what's a savvy investor to do?
Well,
The book seems to be pointing towards a specific type of investment as a potential solution, right?
yes, the book highlights indexed products as a way to mitigate the risks associated with chasing average returns.
Indexed products.
Yeah.
Hold on for our listeners who might not be familiar with that term.
Sure.
Can you give us a quick rundown of what those are?
Of course, think of indexed products as taking a different approach to investing.
Okay.
Instead of trying to beat the market, which is what many traditional investment strategies aim to do,
Right.
index products aim to match the market's performance.
So instead of picking individual stocks or trying to time the market, you're essentially going with the flow.
Exactly. It's like betting on the entire field in a horse race rather than trying to pick the winning horse.
Interesting analogy. But wouldn't that limit your potential gains?
That's true, but you also avoid the risk of those big losses that can completely derail your investment strategy.
So it's all about finding the right balance between risk and reward.
Absolutely. And that's where understanding the zero is your hero concept comes into play.
Now that's a phrase that keeps popping up.
Right.
What's so heroic about zero?
With indexed products, the goal is to never have a negative return.
Okay.
That means your principal, the money you initially invested, is protected.
So even if the market tanks, my investment won't go down.
In theory, yes.
That sounds almost too good to be true.
It's not magic. It's a different approach to risk management.
Okay.
We can dive into the specifics of how these products work in a bit more detail in the next part. But for now, the key takeaway is that they offer a level of safety and predictability that traditional investments often lack.
Okay, so we've learned that average returns can be deceiving
Right?
and that index products offer an alternative approach focused on minimizing losses.
Yeah.
What's next on our deep dive agenda?
Let's take a closer look at these index products, how they actually work,
Okay,
and whether they might be a good fit for you.
sounds good.
All right.
Okay, so we've established that zero is our hero,
Right.
but how exactly do these index products work?
Well,
It all sounds a bit like financial alchemy to me.
well, it's not magic,
Oh,
but it does involve some clever financial engineering.
okay.
One common approach is the use of options contracts.
Options contracts.
Yeah,
Okay, you're going to have to break that down for me.
sure.
I'm picturing, complicated Wall Street jargon.
Let's simplify it.
Okay.
Think of an option as the right, but not the obligation
All right.
to buy or sell something at a specific price in the future. In the context of indexed products,
Yeah.
these options are used to create a sort of safety net for
Okay.
your investment.
So if the market goes down, the options kick in
Exactly.
and prevent my investment from losing value.
Exactly. It's like having insurance on your portfolio.
Ah, okay.
Protects you from those big drops, ensures that your principal remains intact.
That makes sense. It's starting to click now.
Good.
But if these options are acting as the safety net,
Yeah,
doesn't that mean that someone is paying for that protection?
they're sharp.
Where does that cost come from?
Yes, there is a cost associated with these options.
Okay.
And it typically comes in the form of slightly lower potential gains when the market is doing well.
So a trade-off.
It is a trade-off.
You give up some of that potential upside to gain that downside protection.
Exactly.
That seems like a reasonable compromise,
Right?
especially if you're someone who prioritizes stability and peace of mind
Absolutely.
over chasing those big returns.
Precisely. And this brings us back to the importance of aligning your investment strategy with your individual goals and risk tolerance.
Right.
Indexed products are a powerful tool,
Yeah.
but they're not necessarily the right fit for everyone.
Right. It's not about finding the best investment strategy
Right.
in some abstract sense, but rather the best strategy for you,
For you.
for your specific circumstances and your financial goals.
Absolutely. If you're young and you have a long time horizon, you might be more comfortable with a higher level of risk.
Right.
You might even embrace those market dips as opportunities to buy low.
But for someone who's closer to retirement
Yeah.
or someone who simply can't stomach the thought of seeing their savings plummet,
Right.
index products offer a way to sleep soundly at night,
Absolutely.
knowing that their money is protected.
That's a great way to put it.
Yeah.
It's all about finding that balance between risk and reward.
Right.
Indexed products tilt the scales towards safety and predictability.
But as with any investment,
Yeah.
it's crucial to understand the details before diving in.
Of course.
What are some of the key things that listeners should keep in mind
Okay.
when they're evaluating these index products?
That's a great question. First and foremost, remember that zero is your hero.
Right.
These products are designed to protect your principal,
Right.
not necessarily to generate huge returns.
Right. We've established that, but what about fees?
Yes.
Are there any hidden costs associated with these products?
Transparency is key.
Okay.
Always carefully review the fee structure of any indexed product before investing.
Right.
Compare it to other options. Make sure you understand exactly what you're paying for.
Good point. Fees can really eat into your returns over time,
They can.
so it's essential to be aware of them. What else should listeners be on the lookout for?
Pay close attention to the index that the product is tracking.
Okay.
Different indices have different levels of risk and potential return.
Okay.
Make sure the index aligns with your overall investment goals.
So if I'm looking for stability and income, I might choose an index that focuses on dividend-paying stocks.
Exactly.
Okay.
Or if you're comfortable with more growth potential, you might opt for an index that tracks a broader basket of stocks.
Got it. So do your research, understand the fees, make sure the index aligns with your goals?
Yes.
Anything else to add before we move on?
Just one more thing.
Yeah.
Remember that past performance is not indicative of future results.
Right.
This is a common disclaimer in the investment world,
Yeah.
but it's especially relevant when considering indexed products.
Mhm.
Just because an index has performed well in the past
Right.
doesn't guarantee it will continue to do so in the future.
Okay. That's a crucial point.
It is.
So we've covered the basics of index products.
We have.
Their
Yeah.
pros and cons and some key things to watch out for.
Yeah.
What's next on our deep dive agenda?
Let's bring it all together
Okay.
and explore how this knowledge can empower listeners to make informed investment decisions.
Okay, so we've really gone in depth here. We've explored the myth of average returns, learned how negative years can impact your portfolio, and discovered indexed products as a potential solution.
We have.
But what does it all mean for our listeners?
Right.
How can they apply this knowledge to their own financial lives?
That's the million-dollar question, isn't it?
It is.
I think the biggest takeaway here is to approach investment claims, especially those touting average returns, with a healthy dose of skepticism.
Right. Don't get lured in by those flashy numbers
Exactly.
without understanding the whole picture.
Remember the example we talked about earlier?
Yeah.
The investment that lost 50%, then gained 50%?
Uh-huh.
Seemed like it averaged out to zero, but the reality was a 25% loss.
Right.
That's the danger of not factoring in the true impact of those negative returns.
So it's like those optical illusions,
Yeah.
where your brain tricks you into seeing something that's not really there.
Right.
Average returns can have that same deceptive quality.
Absolutely. And that's where tools like MoneyChimp can be so helpful.
Right.
I know we've mentioned it a few times,
Yeah, we have.
but it's worth emphasizing.
Yeah.
It allows you to play around with different time frames and see for yourself how average and actual returns can diverge, especially when those negative years come into play.
So listeners, if you haven't already, I highly recommend checking out MoneyChimp.
Yes.
It's a fantastic resource for visualizing these concepts and getting a clearer understanding of how different investment approaches can play out over time.
Yeah, and beyond the numbers themselves, I think the key takeaway is to really think about your personal risk tolerance. How comfortable are you with the idea of your investments fluctuating?
Right.
How would you react if your portfolio suddenly dropped 20% or even 30%?
That's a great point.
Mm,
It's not just about understanding the math, it's about understanding yourself
exactly.
and what level of risk you can truly handle emotionally.
For some people, the peace of mind that comes with indexed products,
Yeah.
that zero is your hero guarantee, is worth the trade-off of potentially missing out on some of those higher returns.
Right. But for others, that might feel too restrictive.
Yeah.
They might be willing to accept more volatility
Hmm.
in exchange for the possibility of bigger gains.
Exactly. There's no one-size-fits-all answer.
Right.
The key is to find an approach that aligns with your individual goals, your time horizon, and your emotional capacity for handling risk.
So as we wrap up this deep dive,
Hmm.
what's the one piece of advice you would leave our listeners with?
Don't be afraid to ask questions.
Oh, okay.
Challenge those assumptions. Yeah. Dig beneath the surface of those flashy marketing materials.
Right.
And remember that when it comes to investing, knowledge is your most valuable asset.
Absolutely. Well said. Keep learning, keep exploring, and make those informed decisions that empower your financial future. Thanks for joining us for another deep dive. We'll see you next time.